Our guest today is Michael Frazis, founder of Frazis Capital Partners, a Sydney-based hedge fund investing in the fastest-growing companies across growth equity and life sciences. Michael studied chemistry at Oxford, completed his master's in finance at LSE, then spent 5 years in private equity in London before moving back to Australia to launch his fund. Over the past 3 years, he's delivered 34% annualized, one of the standout return profiles in global growth investing. Today, we discuss growth investing, market cycles, and AI in biotech. You don't want to miss this episode. This is episode 8 of the Strand Global Macro Talks. Hi, Michael. Thanks so much for joining us. This is Strand Global Macro episode 8. So, you are a famous investor specifically in growth equities. And when I mean by growth equities is that I've seen that you previously stated that you really like when companies are usually not profitable, the first stage of the growth cycle, because that's when the growth is the highest and you think that there's the highest potential for growth there. Mostly these companies, growth companies which have very high PE multiples, the top line is usually forecasted very aggressively. And what brings me to this is that I saw a stat the other day, and it was like the top multi-managers at huge hedge funds, usually 50% of their variant views are on the top line. So when you're investing in growth and top line is so aggressively priced in, do you think that you're looking at more a revenue growth, a future margins, or a durability of the business model thesis?
Yeah, thanks for having me on. I mean, I'm not sure I'm that famous of an investor, but I'll take the compliment. Look, it's a good question. I think a lot of growth companies traditionally are loss-making, particularly because they're investing in growth and they try and do it through the income statement. That was definitely true for, say, software companies over the last 10 years and most of the time going backwards. But if you look at the fastest growing companies now, they're actually extremely profitable, in the semiconductor space, for example. So it's almost been like a challenge for growth investors and value investors. Typically, the value investors would just ignore companies like that are growing so fast, where you have to make all kinds of assumptions about their future. But they're also really profitable. Even Nvidia came down to a forward P of almost 15, probably 2 or 3 times in the last few years. So you couldn't say it was an unprofitable company, but it was, for most of that period, growing at over 100%. So it's not necessarily either or. I think that the long answer is like how I ended up with my strategy and why it worked when it did and why it worked when it didn't, and why it's, I guess, working pretty well again. I started right after the financial crisis of 2009. And it was kind of, even that was almost a second crisis from 2000, the dot-com. So that's when the growth had its last big rip. Like the 90s were amazing. Lots of people made absolute fortunes buying growth stocks. And then basically tech sold off and value outperformed throughout that period. All the money went into value funds. A lot of those value funds then got caught in financials because they obviously looked really cheap. People bought, and then a lot of those balance sheets got wiped. And the ones that didn't kind of shrank, whether it's, if you look at a share price for something like Credit Suisse, it was just shrinking every year and the share price just always seemed to be cheap. But it was always just a year or two ahead of where the fundamentals were deteriorating to. There's actually a pretty interesting analogy now with what might happen with software, for example. Whereas if they're losing at the margin, it looks like they're cheap and they've sold off now. But if they do start and continue to lose revenues and customers, which, by the way, you haven't actually really seen at the moment, but it could happen, that kind of long bleed out over 5 to 10 years could really be a big thing. But, after the dot-com, almost every institutional investor was a value investor. The investors that were around before then that were very growth focused basically didn't exist anymore. So there wasn't a single growth fund in Australia, for example, where I'm from. Every single one wound up at some point over that period. And that was pretty similar. I mean, obviously the US is much bigger space, Europe is much bigger space, but there was a mass kind of extinction event for growth funds. And then in the wake of the financial crisis, growth stocks basically went up for the better part of, basically till 2021. And it was huge outperformance. And basically the extent to which you performed was the extent to which you invested in technology and the fastest growing companies in that space. And one by one, these companies were growing. I'm talking about Amazon, Google, at the top end, but many smaller companies as well. These companies were wiping out entire industries, like physical retail, anything advertising related. Obviously, all that spend went to Google and Meta. It was a really long, slow bleed out for those companies, and growth massively outperformed. But what happened then is the outperformance was too much. And then by 2020 and 21, that was kind of like the peak. You know, it was like COVID was like perfect for tech and growth. It's like everyone's staying at home, screen time's going up. Obviously, there are technology advancements going on at the same time. But it's kind of like at the end of 2009 to say 2020, so more than 10 years. And then you got this final boost to all those companies. And that's when the institutions finally flipped and everybody was investing in growth funds and growth stocks and growth equities. Now, what kind of happened was it actually changed the market. You know, there was this self-reflexive dynamic going on where the companies changed. The companies were like, well, if I'm a growth company and I get a sales multiple, I'm going to be valued vastly more than if I'm managing for cash flows. And it's almost like that rush for companies in this, for growth companies, like summoned out these like fake businesses out of the ether, you know, and they're listed as SPACs and they're basically selling $2 for $1. But obviously you can grow extremely fast if you're doing that. You know, these were loss-making companies. And then there was a huge extinction event in all those companies where the ones that were losing too much money either didn't make it through or, you know, haven't recovered. And it's 2026 now. So that was 5 years or so ago, and they've still been performing terribly. So I think it's not necessarily a trade-off. It's always been about unit economics and value to capture a customer. As long as those things are heading in the right way, there's nothing wrong with a company spending that money or investing that dollar to get $5 back over the next few years. You know, that's like very sensible, very rational. Where it gets a bit irrational is if you're spending $2 to get that dollar of revenue and you're getting a multiple on that, and you're assuming an inflection in margins. And I'll give one interesting example of where that everyone thought that would happen but didn't, and that's actually in software itself. So there's a lot of companies in software that are actually really mature and by now should have been making a lot of money, but haven't been able to get GAAP margins. So if you had modeled something like Atlassian, which massively outperformed on growth over the last few years, and certainly over its entire lifetime, it still hasn't been consistently GAAP profitable ever. But this is a company that's been around a long time. It's like the established, entrenched incumbent. It's not in that hyper growth phase, but it's never been able to get there. And that's kind of interesting as well. And it's interesting now that the performance of companies like that has been very particularly poor lately. But it's hard. You know, the value investors aren't going to buy something that's not GAAP profitable. And growth investors are looking at other parts of the market that are growing faster, like semiconductors. And if you're a growth investor, you really are looking to the future, like what's going to do best over the next 5 years. And you probably don't come up with software. You probably come up with physical hardware and power and things like that. In many cases, we know the CapEx plans, you know, 12, 24 months out, we know there'll be growth. And I'm sure you're aware, if you've been following markets, there's been like these AI bottleneck companies that have had this huge uplift in performance where basically random industrial companies just ended up making something that's turned out to be helpful for data centers. And instead of like plodding along as they did for the last decade, all of a sudden they're getting these excess growth. But, you know, I've seen so many of these things now. Like those stocks are up 20, 30, 40 times. The future's priced in. The forward returns aren't going to be that good. Everybody's piling in. It's probably one of the riskier parts of the market now, even though it was really exciting, you know, 6, 12 months ago. Does that answer your question? I feel like there are a few points in that.
Yeah, I mean, it definitely does because I now understand your perspective of why you wouldn't look at profitability in the short term because you're, at the end of the day, if you're growth investing, you're looking at a 5-year time horizon, for instance. Even though it might have to be a 5-year holding period, you're looking at the long run. And then when that in the 5-year gets priced in, share price moves. Also, I mean, the AI, like everyone's trying to pilot into AI infrastructure. And if you saw this ex OpenAI researcher who started his hedge fund with like 200 million, and he published his 13F, and it was like last year he published his 13F, and he's like at 13 billion, and he's making ridiculous calls on some of this like AI infrastructure, like Bloom Energy, great company. And you know, he just recently bought a lot of puts on all of these AI companies. So I'm gonna look into his 13F more strongly. So my second question is, you obviously studied chemistry as undergrad and masters, if I'm not wrong, and you also have so chemistry at Oxford and then LSE masters in finance. And I think that your research was on fuel cells, something like that. For someone who doesn't have a clue about chemistry, what are some ways that you can apply chemistry to have some type of specialized knowledge and get an edge in today's market?
I mean, there's parts where it helps, but I'd say that it's been other things that have been most helpful. Like we moved in a very quantitative direction. So that's basically been the big shift for us over the last few years, is to broadly picking the same kind of growth opportunities, but really managing the risk quantitatively. So most of our buys and sells are based on models that have actually worked extremely well over the last few years. I'd say I do a bit of biotech investing, and they're having a scientific background is really helpful. But at the same time, I wouldn't want to overplay it, because if you're a generalist investor or even a biotech specialist, you're still never going to know as much as the people in that industry. You know, the doctors that treat all those patients every day, the researchers working at the cutting edge. You're probably going to be managing a portfolio of 20, 30, 40 stocks, maybe 2 or 3 times as many that you're monitoring. You've always got to respect the fact that to some level you don't have a deep understanding. And that's probably why we found quantitative approach to risk and to trading has been so much more effective than when you're just kind of, what's the right word? I guess speculating. You know, you're kind of like taking these views and you're just waiting for the market to appreciate your view. And if the market turns against you, and it could be for 100 different reasons, it's very hard to figure out if you're wrong or if it's just the market's down and you're in small cap healthcare. So obviously that's going to be down more. You know, it's very challenging to do that if you're trying to guess it each time. But if you have a quantitative model, you can kind of be like, I'm going to take a long-term view on this, and I'm going to buy and sell it based on this model. And if it reverses, I'm going to be quick to exit and quick to re-enter. And there's many, many, many ways of doing that. Yeah, I think if anything, I feel like in investing, you go through periods of performance where you do really well, and then you get kind of arrogant, and then you get humbled, and then you become good again. And then the more years that things go well, you get looser. And then something, you get like a bit of a shock, and you lose more money than you thought you would. Then you have to tighten everything up. And I think I've been through that cycle probably 3 times over the last 15 years. This time we're trying to be quantitative and structured the entire way through, and try and not get caught on the other side the way we have in the past. Yeah, I mean, you mentioned that fund. Presumably that's Leopold Aschenbrenner. I think there's an interesting thing where every year or every market period or market what's the right word? Market environment. I'll think of the right word. There's always something that's performing. It might be energy, it might be shale, it might be software, and there's always somebody who's like 100% levered to that factor, and then they do extremely well. And often they pick up huge followings on Twitter. I mean, Leopold, I think, doesn't, other than his 13 Fs, he's not one of those people that's kind of promoting lots of stocks. But there are people that do that. And if they just happen to be on that right factor at the right time, then they quickly amass this huge following. Everyone follows their trades. But factors always reverse. They always overshoot and then reverse. And so at some point, and I don't think it's, if I had to guess, I wouldn't think it's now. Our strategy is obviously quantitative, so it doesn't depend on us figuring out exactly when that cycle turns. But at some point it will, and that factor will be down 60, 70%. And it's one thing I've learned over the last 15 years. It's the downside in anything growthy or a particular factor. It's not 30, 40% or 50%. It's 60, 70, 80, 90%. And I've seen that so many times in different environments. Like, obviously we saw it in software twice that has seen 60, 70, 80% drawdowns. Shale oil, there was a time, 2011, 2012, there was a big rip in certain commodities. In Australia, there were lots of junior iron ore miners. They were red hot. Shale producers in the US around a similar time, and they all basically went to zero. The downside of being exposed to one factor and taking a long-term factor view can be much greater than you'd think. And it's always painful, because if you are taking that big factor bet and you've got your whole fund in one thing, if that reverses, there's a good chance the market's up. You could be down 60, 70% and the market would just be grinding higher. In this case, it would be kind of like, in that case, it was like, well, energy prices have come down, so that's good for every other company, even as the shale industry gets obliterated, or whatever it is. That's just an example. An example now would be like, well, imagine if memory prices collapse. Well, that's terrible for the current hottest trade, which is like memory traders and semis and related industrials. But everybody else has to buy these things. It's a huge part of AI. So the cost will come down for everybody else. So the market could actually grind higher in a world where that whole sectors under pressure. So the people that are doing like are really shooting the lights out now are like max exposed to that one factor. They'll either have to be right that it's actually, markets don't like work like that. It'll price in like markets will just rally way in excess, price in 5 to 10 years of success. There'll be a hiccup and then they'll fall far more than they should have. That's like the most likely outcome. But yeah, I think I think taking a long-term bet on one factor, one industry, one subsector is extremely risky. But it is also a way to get returns that are exceptional. If you just bought semis and bottleneck companies and things like that, you could be up 5 or 10 times or more, over the last 6 months, because that's what that sector's done. So I guess it comes back to that risk reward thing, and sometimes you just have to be right. But just be aware that story with Leopold, I mean, to some extent, I was never like that famous, but in Australia, I was that person in 2020 that was like max exposed to the best, to the perfect factor at that time. And I'd been doing it for a long time and been grinding out very strong returns before that. But at that moment, like the market just came to me, and like what I was investing in at that time was just what everybody wanted and just went vertical. I think from the COVID lows, we went up 4 or 5 times in like less than a year. It was a huge shift. But then as the market rolled, at the time we had a different strategy. We didn't really use quantitative risk models. At the time we're max exposed. So when all those companies dropped 60, 70, 80%, we dropped a similar amount. And that's hard to deal with. Like it is a fund, it's obviously extremely difficult. And generally you raise the money when at the end of a return cycle, not at the beginning. So obviously long-term investors, even at the low, were still up. But if you invested in, at the short, if you invested at the top, you had a terrible experience, and that's obviously very difficult for everybody, as it should be. So yeah, I think when you look at those funds and people doing that, just be aware that they're very focused on one factor. And you mentioned that he bought a lot of puts. It's hard to know in those disclosures what they are. Like they could be very short term, very out of the money puts that pay off if the market drops 50%, or it could be an extremely expensive bet where it's 5 to 10% to hedge the whole book for many months. We just don't. I don't think they disclose that. I think they just disclose the notional. Yeah, it is interesting though. It's interesting that he's done that. If he can catch the turn, then that will be a stellar outcome. And so he's probably thinking, that's probably the thinking behind buying all the puts. It's like, I've just made these huge amounts. Why don't I give a bit of it away? And if there's a short-term unwind, I'll make money on that side and then likely go again, Is that helpful, the answer?
Yeah, yeah.
Yeah. So I'm going to ask you a question now. So of course, you have previously had a lot of media exposure. So the podcast and publishing all the research notes. And my question was, how do you think this media exposure has actually benefited your fund? And is it something that you recommend other boutique managers as well to adopt? I mean, we have recently started our podcast as well. So I was really interested in understanding how this media exposure has actually benefited the fund and changed. Yeah.
I think most of the media exposure we get comes from people reading the letters. So even like we just got a couple of mentions in the papers here, and that was just purely quotes from the letters that I sent out. Like I haven't even met those journalists or been in touch. It's a double-edged sword. All the old people told me that, and it was true. Like if you go for that media exposure, then you also kind of become a character. So then if anything goes wrong, there's now a great story, whereas if you're in the shadows and something goes wrong, well, what are they going to write about? Something happened to some random person? Like, it doesn't make any sense. But something bad happened to somebody that was in the papers for something else. All of a sudden there's a story that can draw a narrative arc, all of a sudden it becomes much more interesting. I started my career in the UK and came back when I was 26, didn't know anybody. Obviously had family here, but I'd raised, I think I didn't have any industry contacts, didn't do my first job here, didn't come through the kind of usual pathway where you meet all the brokers, you meet all the investors, you meet all the companies. I really came here with like no professional network. And so I kind of had to do it. I think if I did it again, which is basically what we're doing now, is like just focus on your own stuff and your own channels. And that's the right way to do it. I don't think the press is going to really help you. I mean, they're looking for a story. So fund doing well is kind of interesting. Fund doing well then badly is very interesting. I think the right way to do it is what you're doing, is setting up a podcast and actually writing investment notes. So if you really want to do well in this industry, there's like this amazing platform, and this wasn't available when I was there. Actually, if it was like a nascent, like less than 1% of what it is now. But if you write a good detailed research note, people are going to read it. You post it on Twitter, tag the stock. I can promise you every major holder of that stock is going to get an alert and they're going to read that. And if you've done a good job, and the way you do a good job is by just doing a lot of these and getting better and soliciting feedback and being really self-critical and trying to improve it. If you do a good job and you write a note and you've got that variant perception that you're saying, it's gonna spread, and you'll get some followers. You'll start getting funds following you, and then you get opportunities based on that. And if you happen to get a bunch of things right and you're doing a really good job on your calls as well as the work, I don't think you have to get the calls right, by the way, to get benefit. Like even if you ends out you're wrong on something, if people are like, well, that was interesting, well-researched piece, that's something I want to read more of, and I wonder what he writes next or she writes next, that can also build an audience. And then that's super powerful. And then, there's many people that have got jobs off Twitter research. There's many people that have raised funds off that. There's no gatekeeper. A lot of these accounts are anonymous and still do extremely well. It's not about who you know. It's really about the quality of the work and whether people find value in it. And broadly, people are right. I'd say people, on average, the people that write really good content tend to be discovered and tend to be shared around amongst people that own that stock. That's a really good avenue, and it's something, especially when you're at university, you can just do it. Yeah, I'd invest heavily in that. And then when you go for a job interview, you've got like a whole number of notes that you can refer to. You've done the work on a number of companies. Compare that to somebody that hasn't done that, and you're interviewing at the same job, and you can talk in detail about 10 different stocks, and the work you've done and how you did the research and how you valued the companies and what the market was thinking, what you thought was different. That's a completely different conversation to somebody that comes in and it's just a general chit chat, or maybe that you ask them some technical questions. Like it's a really good way to separate you, and it's also very fair because you have to do the work, you have to write a good piece, you have to do it properly and do a good job. And I think it's great. I think that's what people do. And to go back to your question on media, that's basically my focus now. Just focus on the people that are interested in what I'm doing, try and do good work, post it out to them. It's a bit hard because I like to be able to change my mind fast. And I found when I was like publishing, top 20 stocks and things like that, I might sell something and then buy it back, especially now we're on quantitative models. But even before we were using these quantitative risk, I might change your mind and change it back, over a 3-month period. And if you've got that, if I was like telling people in real time, then that created all this friction and it made it harder. It's like, oh, I don't want to sell it and I have to write. It just added this other factor that you had to think about very carefully about how you're going to describe that, which I found actually was detracted, if anything. Like you want to be as clear, like this game is hard enough. You want to be super clear headed. You don't want to be worried. You want to be trying to figure out if you should be buying or selling something. You don't be thinking, I wonder what everybody thinks if I buy and sell this, and have to write it up. That's kind of was my experience, and why, if anything, we've probably become a bit more general in the notes that we put out, a bit less specific, because and I think I just want that flexibility to be able to very quickly change course without worrying about what I've written or what I've said, or whether I've changed my mind but I haven't told people I've changed my mind. I find that a bit of a restriction. But in your situation, you don't have that. You can just really just write these notes, and I can assure you, you don't have to be right. Like if you write a really good and be clever about it, pick like the topical stocks that everybody's watching and just do some work and see if you have an opinion that's different to what people are thinking. If you want to practice your valuation skills in preparation for job interviews and things like that, do it on those stocks, write them up. That will get attention. You'll get thousands, tens of thousands of views if you do a good job. And there's a lot of hedge fund managers. Every hedge fund manager on Twitter now, basically. People are tracking these things. People are looking for. It's actually pretty hard to find people that will go out and do that and are really interested and write good work. And if you've got that like public portfolio, that's going to be really helpful. I'd do that rather than I'd focus on that, building your own audience, cultivating it, and then just writing to those people that are supporters.
And looking back at your past, so earlier in your career, you of course undertook an internship at Goldman Sachs and BCG, which of course are two very different, but of course really prestigious institutions. And of course, these experiences have clearly played a role in shaping where you are today. So my question is, in this current landscape that we live in, so nowadays, do you think is it necessary to gain experience specifically at an elite firm to succeed in investing? And if so, what do you think those environments, so of course the elite firms environments, can offer more than a smaller or less prestigious firm cannot?
Look, I think I'd say the same thing pretty much every else would. If you can get those jobs, take them. You do learn a ton.
Yeah.
And I don't want to ever play it again. Like I was internships. It wasn't like I spent years at those firms.
Okay.
I ended up working for a small firm, so I actually did the opposite. I worked for a small private equity firm in London. The one thing, like there were many good things about that, but the one bad thing was that if I had job offers at investment banks, if I took one of those, then I would have met hundreds of people. I would have gone through the grad training program, met people from all around the world. That's why I would have been super, super valuable and super helpful. And I didn't go down that path. I didn't meet those people. I didn't get that experience. I didn't go through that with all the peers, all the training in those places. And like I don't think it matters. I'm not sure how much it matters how prestigious the firm is, but you do get exposure to people of different ages, different seniorities. You'll learn how the senior people operate, how the mid-level people operate, how your direct, I guess like if you're an analyst, how your associate does their work. You learn a ton from all those interactions. In terms of like whether it helps you like be a fund manager or something like that, like there's a really good, there's a pathway. Like they'll obviously they'll hire the top people out of those firms very happily. The big funds, which again, like if you have one of those opportunities, always I would advise, and I'm not somebody, I didn't take my own advice, but I would advise to go to the most prestigious firm you can get. And that's every year I've spent in the industry has kind of emphasized that. And you can really tell when I meet somebody and then like, wow, that person was sharp. And then you find out they came out of Goldman Sachs or McKinsey or something like that. I feel like you can really tell. It's probably partly because they were selected because they were top of their class and did really well. And partly because they're then surrounded by all these people with extremely high standards that wouldn't accept anything that wasn't extremely high. And the better the better the firm, the more it will be like that. So do it if you can. But if you don't get one of those jobs, most of the successful, wealthy people in this world didn't come through that pipeline, right? It's not like it's all over. If you want to be in funds management, there's a good chance that actually doing really good work and publishing it publicly is a better route. Yeah, if you can get those jobs, take them. If you don't, it's not the end of the world. You're just gonna have to find your own path. But it's never been easy to do that. It's never been easy to find your own audience, to put good work out in public.
Let's circle back to your private equity role in London. I've seen many hedge funds which have started doing this private equity approach to public equities, and they've been very successful at it. Because it's not the standard way of analyzing a public equity. And now my question is, coming from the private equity scene onto public equities, if you had one thing that a non-private equity experienced person could apply to their approach, what would it be?
It's a good question. I mean, the fund I was working at was very credit focused. I think there's probably two things. I mean, be very careful. I learned to be very careful in small caps because if there's a 20 or 30% shareholder, there's a good chance they have a plan. And the outcome is not necessarily just going to depend on the market seeing what you see that it's undervalued. There's probably reasons for that will potentially never even become public. One thing I found really interesting was that we worked a lot in situations where the value cut into your debt. So let's say you've got your debt stack, and then you've got equity. Sometimes the value is like down there, and like working out those and those situations can be really interesting. And as an equity market investor, sometimes you don't see that or you don't get that. Like it'll be like the stock's down 90%. Well, the stock might be down 70, 80, 90%, but actually the equity is kind of trading like an option. The real value, the hard value is kind of below the debt, below that equity line, it cuts into the debt. And if that happens, you have to be extremely careful because there's a very narrow path out. And they're the kinds of companies you just buy the whole way down. And there are a lot of famous investors that lost a huge amount of money doing things like that. Like one example that comes to mind was Sears, which you probably won't know. But there was a guy, one of those people that periodically pops up claiming or wanting to be, or other people saying is the next Warren Buffett, just bought that thing the whole way down. But it was a leveraged company and it ended up, it's not like it wasn't worth anything. Of course it was worth something, but the value cut in at the debt below the equity line. And that's like a concept that's like really obvious in some circles. If you're in investment banking, if you're in credit, that's like really deeply understood. But in equity circles, sometimes it's not, doesn't seem to be very well understood. And you see people talking about it without even really understanding that. And often these companies, this is one of those examples where you can have a low PE, but the equity could cut in below the debt. There's a lot of situations like that, just the way accounting works. And there's like this typical investor journey people do. They're like read Peter Lynch, Warren Buffett, buy value stocks, buy low PE, and then get burned on a few of these things, and then slowly become more sophisticated and think of other ways. So yeah, I'd be that's one thing I'd take away, like on a technical perspective. Just be aware of those situations where the company's worth something, but the debt is worth more.
Yeah, I mean, important insight. I mean, there's a lot of value traps also these days, and I think when you're quite junior, and you just learned about valuation and how to value a company, and you find a company that's massively undervalued, it takes some time to learn what a value trap is, what it's not, what are catalysts to trade around so that you don't get a bleeding position. It's a lot of things that you have to consider. So moving over to your fund, I mean, you published last week a letter, or this week, that your fund has returned 34% annualized over the past 3 years. I mean, you're obviously very smart, very successful, talented. You went to the best schools. You have a very successful performance in your fund. But this high performance, like you mentioned, introduced a high level of volatility. In 2022, you had that, I don't know how many, 4 or 5x. And then in 2020, and then 2022, Morningstar reported that you were 70% down. I mean, how do you kind of justify a such high level of volatility to your investors? And when you have such large swings, does it not make you irrational due to the emotional side of being 70% down or being 400% up, for instance? How do you keep a rational mind when you have such big swings on both ends?
Yeah, look, I think it comes back to that mistake that I mentioned earlier. I don't think you have to have those years to do really well. I think one of the miscalculations was the downside was, I think we dropped 65% that year. The miscalculation was that the downside was a lot more than we thought. We thought we'd be down 30, 40, maybe 50. Didn't expect to be more than 60. And so we've had a long climb out of that hole. You have to, if you drop 65, you have to go up 3 times. If you drop more, you have to go up 4 or 5. It's the numbers get really difficult. And yeah, it's a hard journey out. That's kind of why I was saying that the downside in those kinds of growth stocks is always much more than you think. And then, by the way, those companies did that again. A lot of the same companies dropped 70, 80% in this kind of software sell-off. For me, it's kind of been it's painful because I wish we lost less money and could have learnt that lesson without losing as much in that year. But that year would just not happen again for us because of the way we've designed our risk models. Like I think now we've had a pretty good month this month. Now our rolling 3-year numbers like over 40%. There's no way we would have done that without these risk models, without this quantitative approach. It's a completely different thing. And actually, we designed this entire framework, this entire approach based on 2022. So it was designed for that. I guess growth stocks actually peaked in like early 21, and then the whole market rolled over at the end of 21. So it was really kind of 2 years down. 1.5 to 2 years down. We designed it for bear markets that were extended, like 1.5, 2 years, something like a financial crisis or .com bust, which was 2.5, which was longer. We designed it to put us completely out of the market in those long bear markets. As it happened, it's taken us out of the market or to more than 50% cash 3 times in the last few years. And we basically had to buy everything back on the same model, shortly after. So even though we designed it for long extended bear markets, like the one that was so painful for us and our investors in 2022, it's actually seemed to have worked really well in these shorter kind of flash crashes, even though you'd think they actually would underperform because, you're selling and then you're buying, sometimes buying back higher. So yeah, I mean, there are a few things to talk about there. I think on the investor management, obviously it's tough. Like I just wouldn't recommend it. Especially it's like, they're all people, right? They're all your supporters. They're your friends, family, people that, have been following you. So you really want to do a good job. And when you do a good job, it's the best. It's like you made everybody money. If you do a bad job, it's like the worst. You've lost people that supported you money. So it's not something it's not something I'd recommend, to be honest. And like now our strategy is not designed for that. I can see there's people in the market. There's always been people in the market that will have those swings, be very risk on. Like I know there's very famous energy funds that frequently have swings and moves like that. I really don't think it's necessary to do that. And I think if you are having swings like that, you've made some mistakes, probably a series of mistakes. I mean, for us, it was that miscalculation. It was probably March. I'm trying to remember. I think it was probably around March or April in 2022. So it would have been down, and I'm these are very general numbers, so I'm just trying to tell the story. But let's say you're down like 30% after a few months. Now, for like the 8 or 9 years previously, that was how we made our money. It was like things would be down 30, 40%, would be really aggressive, and then they would double or triple on the other side, make the money back, then go up another 50%. And we did exceptionally doing that. Now, this was that time, the first time since 2008, 2009, where everything dropped 30, 40% and then basically got cut in half again over the 3 months after that. And that was basically the stumble. It was like a calculation. Okay, things have sold off under a ton of pressure. Let's buy the stuff we like. And then it got cut in half again. And then the fact that it mostly recovered afterwards, not all of it, certainly like the good stocks recovered and went on to new highs afterwards. That's like little comfort when you're down that much, right? Like it's 4 years later, we still have to talk about it. And obviously it wiped a lot of like years of work, and it's taken us years to dig out of that hole. So it was very consequential as well. But going back, like I said, I don't think you need to do those years. I think if your volatility is that high, you just made mistakes, and I think you need to reset and restructure. And it's not about taking the lessons and learning. I feel like that's a bit of a cop-out. It's like, well, specifically, how have you changed your strategy so that something like that doesn't happen again? And you can never be 100% confident, but I'm pretty confident our current approach won't have swings anywhere near that, because our risk management models were designed to take us out in, say, January. So the point that I was talking about, we were down 30% plus in March or April, 3 months later, would have been in cash for 2 months at that point. We wouldn't have been in that position. And that's basically the new strategy, the new approach. And, time goes by. It's already been, I guess, 4 years now. And if we do another year, that'll be 5 years from 2022. And so I'm super focused on doing one more good year and then posting a really good 5-year number. And then that will put that episode to bed. That'll be like, we had a really bad year. We restructured. Strategy is infinitely better, vastly more sophisticated. And we posted a really strong 5-year number. And yeah, then we can move on from there. That's my strategy. Don't lose that much money if you can avoid it, though. I don't recommend. You're better off moving to cash before, take a bit of a break, come back. All the really good traders will say similar things. Like if you read George Soros's books, I mean, he fired Stanley Druckenmiller, like his guy that made him a fortune. Obviously firms like Citadel, Millennium, they will cut traders out that lose 6% or whatever it is. I don't know exactly how their models work. They'll cut people out really fast. If you've read something wrong, it's very hard to change. And it's not like you're dead forever, but at that particular moment, you're not seeing things the way they are. You're not acting correctly. If you're losing that much money, you're probably better off just taking a break, and then you can come back, when you're thinking properly, when you're seeing the market well, when the things that you think should be going up are going up. Yeah, the advice that they would give would be exactly, I mean, I say advice, like they'll just fire you if you started losing money. But I kind of understand that now, like on a very deep level. That if you're not seeing things aren't going your way, you're losing money, then you need to really it's probably you, it's not the market, you know.
Okay, thanks. So going back to the discussion before of AI, so talking in specific about life sciences, so AI seems to have like sped up research, reduce costs, and make complex analysis as well more accessible. And in your opinion, since you have a background as well in life sciences, does that mainly benefit the already established players, or does it create a new wave of disruption caused by the new, smaller AI native companies?
Look, I think I've looked at these companies and I wish them well, and they're doing great work, but it kind of misunderstands the issue with pharmaceuticals and the problem that's being solved. It's fundamentally extremely regulated business, which makes it extremely difficult for good reason, for real reasons, to put drugs in human. So, like the GLP-1 drugs were sitting on the shelf for ages, right? Like, and that they were drugs where all the work had already been done. They knew that approach worked, but it didn't make sense to the people in charge at the time to invest in it. You go to Oxford. I remember in one of the rooms there was literally like a whole wall of like books this thick, and each one was like super thin paper, and each one was like different molecules and like drug discovery and things. Like, I couldn't tell you how much science is sitting on the shelf. There's probably a couple of bottlenecks. One of the biggest bottlenecks is first in human. That's not solved yet. AI can't really help with that. The other bottleneck is just the time it takes to get through regulatory processes. And I've kind of gone on a few different journeys, like thinking about that. There's a book, Emperor of All Maladies, which I highly recommend to people that want to kind of learn some stories about it, about why regulation is the way it is. It's very hard to prove something. Like the example that he used was breast cancer and like very radical surgery. And people used to do very radical surgery at a point that we now know would not have helped. Like they were already metastatic, disease was already far too progressed. And these women were still doing these like horrific disfiguring surgeries. And how do you disprove that though? It's extremely difficult. You're going to do a randomized control. Like it's almost impossible to do it. But it was done over decades. They figured that out. And, there's other examples where people wanted to get early drugs to people. They ended up not working, but nobody knows if they work or not. There are instances where drugs that do work, the science was done incorrectly because, say, the nurse gave the drug to the sickest patients. So if you give the drug to the sickest patients out of the goodness of your heart, then you get bad data because those patients might die because they're on death's door. And then all of a sudden you think the drug won't work, and that delays the whole thing because in most instances that will kill a drug. Maybe if there's enough evidence it'll get another run, but that's a stretch. There's a reason like that's so rigorous and so difficult, but I do think at the moment we've strayed far too much on the other side, where it's way too long and way too hard to get these trials done, and sometimes randomized controlled trials aren't really feasible. There's instances where a trial might involve a brain surgery or implanting something in someone's brain, and the FDA might ask for that to be done in a placebo group. I think now we have enough data to be able to do less of that, and things should be moving much faster. Or we invested in a company, data was really good. In Australia, the biotechs are all, you can do phase ones really cheaply. It's probably one of the best places to do a phase one trial because it's extremely they're extremely good institutions that run the trials. They're accepted in America, phase one anyway, and they're a lot cheaper. But the problem Australian companies come into is they don't have as much funding. So they do a phase two or a phase three, but the study's not big enough. It's not taken seriously. It's not credible. It's like worst of both worlds. You've done a study, you've proven to people that it works, but it's not enough. It's not the high burden of evidence. So we had a company that did a phase two trial and then went to the FDA to plan their phase three. And the FDA said you had to do another phase two trial. It's like, okay, maybe in an ideal world, that company would have two phase two trials and the second phase two would be bigger than the first phase two. The 2B would be bigger than the 2A. But you just push that company's development back 2 years. So you're 5 or 6 years away from a drug. And that company has costs. You've just massively increased the burden and the amount of capital it'll take to bring that to market. And I think in this case, the company will be able to do it. But that there must be a better way than these 10-year journeys, I do hope AI and not necessarily AI, but just advancing technology, the ease with which it is, we can analyze data, collect and analyze data. I really hope that is used more and that can be used to speed it up, but it's a regulatory problem. It's not a science problem.
Okay.
Yeah, I think those AI companies, it's easy to, there's a lot of candidates that are not explored and not funded. The issue is the funding, the first in human, and the sheer length of time it takes to get something into development. There may be a time in our lifetimes, I'm sure it will happen, where you could model a human body well enough to actually test drugs out in real time. I'm not sure. I hope that's possible in our lifetime. If that's the case, then you'll get the benefits. But at the moment, we can be like, this is a promising drug, it works there, but we don't know how it's going to work. Like, obviously, people and animals, we're extremely complicated beings with huge amounts of biochemistry and different things that interact. Until you put something in somebody, it's very hard to know what those reactions are going to be. Like, we're nowhere near that. If we did have that model that was like, you could be like, okay, I've got this promising drug candidate, put it in that, then all the AI programs would rapidly accelerate. But I feel like that's another thing that needs to be done first before you get that acceleration.
All right. Thank you so much for joining us. This was episode 8. We're going to be publishing an episode every week, so make sure to like and subscribe. Thank you so much, Michael, for joining us.